Welcome back. So far we've spoken about a couple forms of early retirement, MRA plus 10 and VERA. There is another way to retire early. It's called quitting. What happens when you quit? Can you get a pension based upon the service that you have done already? And the answer is actually, it depends on whether you have at least 5 years of service or not. If you quit with less than 5 years, you're not vested yet in a pension. And so you're not going to be able to get a pension in the future. However, if you quit with 5 years or more of service, you could get a pension at some point in the future. But I'm sure you understand that you're going to be walking away from the federal benefits that you could have been accumulating all those years had you stayed a federal employee. Think about what would happen had you remained a federal employee. So first of all, you get your TSB match. The agency matches 5%. So if you're going to work someplace else, is your new employer providing you with a 5% match? If they're not providing you with a 5% match, you know what they need to do? They need to increase your salary by at least 5%. Also, is your new employer going to provide you with health insurance? Because as a federal employee, you have FEHB, and the government pays about 70% of the premiums. Is your new employer going to provide you with health benefits? And even if they do provide you with health benefits, are they going to provide you with health benefits in retirement? Most employers do not provide health benefits in retirement. So if your new employer is not going to provide you with health benefits, you know what they need to do? They need to increase your salary so that you can now afford to buy the health insurance on your own. And lastly, is your new employer going to provide you with a pension? Most employers do not provide pensions anymore. Now let's think about what that translates into. Let's say you were planning on working for another 10 years. And the question was, should I work 10 years for the federal government or should I work 10 years in the private sector? Had you worked those 10 years in the federal government, you'd get 1% of your high three for each year. So 1% times 10 years, that's 10% of your high three average salary. Let's say your high three average salary would reach $200,000, which is not so crazy because right now, if you're at the top of the pay scale in the DC metro area, you're making about 183, 185. So 10 years from now, there's a very good chance you'll be making $200,000. So if your high three is $200,000, 10% of $200,000 is $20,000 a year, every year for the rest of your life. Is your new employer going to provide you with a $20,000 a year pension? Most employers don't. So what that means is your new employer will have to compensate you enough so that you can now start saving money on your own, so that you on your own can recreate a $20,000 a year income stream. Do you know how much money you would need to recreate a $20,000 income stream? So I'm going to give you a ballpark, and I recognize that even this is not going to be perfectly precise. There's something known as the 4% rule. If you're going to be relying on your investments for income in retirement, if you are withdrawing from those investments to the tune of 4% or less, your money will statistically last you for retirement. It's not guaranteed. However, it's statistically strong. Your money will last you for your retirement. However, if you are withdrawing above 4%, let's say, for example, 5% or above, so then that is statistically dangerous. Very unlikely your money will last you for retirement. So let's just assume 4%. In order for you to have a $20,000 income stream, $20,000 will have to be 4% of a larger pool of number. What is $20,000 4% of? So if you do the math, it's 4% of $500,000. So in order for you to recreate a $20,000 income stream, you need to have $500,000 accumulated in an account somewhere so that you could spin off 4%, which will provide you $20,000 a year indefinitely for the rest of your life. And remember, we're talking about over a 10-year period of time. So that means $500,000 divided by 10, your new employer will have to pay you $50,000 extra a year just so that after 10 years, you will have accumulated $500,000 and you'll be able to spin off 4% and have a $20,000 a year income stream. And again, that's assuming 4%. And remember, the 4% is not even a guarantee. Had you remained a federal employee, you'd have a pension that was guaranteed by the federal government. So, using that assumption, 4%, your new employer will probably have to pay you an additional $50,000. plus they'd have to pay you enough to make up for the loss of health insurance, plus they have to make up for the loss of the TSB match. If you add it all up, your new employer will probably have to raise your salary about $75,000 above what your current salary is. And I've seen more extreme examples with senior executives where their new employer would have to raise their salary by $100,000, $150,000 above what their current level is. So just understand, if you quit, yes, you may be able to get a pension in the future on the years that you did work thus far. But what you've given away is some very valuable federal benefits. They don't call it golden handcuffs for nothing. So I would definitely think long and hard before you entertain quitting as an early retirement option. I hope you enjoyed this thought. Don't forget to share, like, subscribe. Stay tuned for more content.